You are listening to ChartingWealth.com for Tuesday, the 15th of December 2015. We jump right into the markets. We've been in a confirmed down move on our large chart, which is our two-day chart, since the 2nd of December. Continue to see big down moves. The latest two-day candle for Monday actually shows even more down moves. Now, for the day, the markets were technically up, the overall market. And again, IYY is the total market. This is an ETF, an exchange traded fund that tracks all the stocks in the market, was technically up 0.34%. Now, again, that's just 1/3 of 1%. But technically, the market was up today. And when I say today, I mean Monday the 14th. It was up Monday the 14th, although we do see a continued acceleration down. We don't have any converging that is coming together of the MACD, which is our primary indicator. We have a red down candle with a wick that's about half its down length below it, again showing that the market actually went lower and the bulls were able to pull it up, not keep it as low as the bears had dragged it. Now, if we look at the intraday action, and again, don't forget, we're using a special kind of candle. It is called the Heiken Ashi. That's Heiken-Ashi. Ashi. What is that? Well, it's not the same as the open, close, high, low. It actually is formulated a little different that I think makes the candlestick patterning a lot more accurate. And what we see on the Heiken Ashi type of candle is a greater move down in the morning, some up move in the afternoon. And again, we do see the derivative oscillator on the short chart has lost some of its energy, and we do see the blue MACD and the red signal line coming closer together. Again, not close yet, but they did move in some as opposed to how far away they had been in just the morning candle on the 14th. So confirmed down moves on both the big chart and the small chart. They both crossed over on the 2nd of December, which is rare but happens and is typically a good sign for the market moving in direction of the double crossing on the short and long charts. When you see that happen, you would have done quite well to expect the total market to be going down, which meant you either went short, that is, you could have purchased in your virtual account the opposite of IYY. You could have bought an inverse fund. Again, those are funds that move in the opposite direction of the main index, whether it's IYY, which is total market, SPY, which is the Standard & Poor's 500, or the QQQ, which is the NASDAQ 100. Speaking of SPY, let's go to that next. And again, many times it looks very similar to the IYY. We've got 4 down candles, 4 down two-day candles. It too crossed over going down around the 2nd of December. And we've had continued down moves. Technically, it was up about 0.5% for the day. Acceleration in the down derivative oscillator. And we have a divergence. We don't have a coming together of that two-day line. And remember, the bigger the chart, the bigger the money, the more it takes to pull them over. And we saw in the afternoon there was an up move. Now again, we've seen in the past on the 10th there were a little bit of up moves. In the afternoon on the 8th there was a bit of an up move. I'm talking about the month of December. But again, the market popped up and then sort of digested those prior downs and then moved down again. Could this be a bottom? Could be, but we don't have that confirmed at all yet. We're just looking at one green candle on a down short chart, and short charts don't make large charts, don't necessarily make big moves. So let's just continue to watch on that. Now we'll go back to the two-day chart, and again, confirmed down moves on both the long and the short on the SPY. The Qs, which is again the NASDAQ 100, we saw where we broke our two-day trend line back on the 8th. That is the two-day candle on the 8th. I'm sorry, the 10th. And then we've seen over the 14th of December, big down candles. So we've got some big down moves that we've seen happening over the last few days. We also, if you pay attention to the Bollinger Bands, those are the volatility bands, and on our charts they are a blue dashed line. Shows you that as far as the volatility, that is the movement in price, As they get closer together, it shows you that volatility is reducing, and that has been happening over the last several days as the volatility has reduced. And again, the Qs are widening over the course of this last 2-day candle, so no converging, what we call diverging in the MACD and the signal line, meaning that that move is not turning around as far as what the signal line and the MACD in particular are telling us. Also, the derivative oscillators heated up pretty significantly. When we look at the short chart, what do we see? Well, we see it looks very similar to what we saw on the 4-hour charts of IYY and SPY. Down movement in the morning and some up movement in the afternoon. Technically, the Qs was up 0.76% for the day. But again, confirmed down move on the Qs, confirmed down move on the SPY and the total market. So we'll continue to watch. We are in down moves on the major market indexes. Now, lastly, what do we always go to? Well, we range back out to our 2-day chart and we go to gold. Gold was down 1.28% for Monday. Now, when we look at the 2-day chart, we see gold getting very close to crossing over, going up. Derivative oscillator has already crossed over, actually did that back on the 8th on the 2-day chart, but it's not crossed over yet. And if we go to the 4-hour chart, what do we see? The half-day chart, we see that it has crossed over, going down. Now, this 4-hour chart has been very, very good to us in the past up until we had the sideways slippage starting around the 12th of November when it told us it was going up. And what did it do? Well, it tracked over and went down for about 2.5 weeks or so. Then it popped up a little bit and then has sort of tracked over and crossed over, going down. Now, if I had to talk about reliability of this chart, it works so well for us up and down up until we saw there in about mid-November when it went south on us. What we want to pay attention to is how accurate will this down chart be? Even though the up side of the 4-hour chart may not work for us, the down may work on gold. And remember, reverse gold funds are available. We do have a crossover going down, and at the same time, derivative oscillator flipped. We like to see the derivative oscillator and the MACD moving over, going down at the same time. Always makes us feel good. If you want to do a potential, again, we don't ever give you advice on how to do real trades. We're always talking about virtual trades. We are not a stock calling service. I'm very adamant about that. We're an education company. We talk about how to read a stock chart, and we encourage you to practice. You might think about practicing here and seeing. There's nothing better to see about how things do than actually to make virtual trades on them and follow it. See if indeed this move, when the market opens tomorrow, let it settle out until about 10:30 or so, and then pay attention to what's actually going on with gold and see if indeed that gold market's going to continue to move down. You could have some nice down movement all the way. It may stop again at this 100.5. So the $100.50 mark is where it's bottomed out for us in the past. That might be a good floor for you. You might be able to ride it all the way down, another $1.50 or so. And again, those of you who aren't that knowledgeable about trading might say, wait a minute, why would I buy gold only to watch it go down? You would be purchasing either a gold, if you're really sophisticated in trading, you might actually buy a put, or what you might buy is an inverse gold fund that actually goes up when gold goes down for your virtual trading. Just experiment, figure out how things work. Folks, that is our review of the market for Monday, the 14th, as we go. Well, it's actually the review for Tuesday, the 15th. It's what went on Monday, so you can be ready for the market when it opens on Tuesday morning, the 15th. Now, the things I've talked about, some sophisticated things here for those of you who've not traded before, not learned to invest before, I would encourage you to, all you have to do is go sign up for our daily newsletter. We will send you for free. With that first newsletter, you will get a link to our How to Read a Stock Chart video. And you can watch that. It takes about 12-15 minutes, and it will actually explain all the things I've just been talking about. What is the MACD? What is the derivative oscillator? What are these exponential moving average, linear regression lines, Bollinger Bands? Well, how does the price history work? What are candlesticks? All that stuff. We talk about that. Quick, down and dirty video that will allow you to get your feet wet and then start following what we do a little more intelligent, with a little more knowledge as you go along. Additionally, you'll also get, besides that link to the video, you'll also get another thing that's very helpful. It is actually the layout that we use here, preloaded with all these different types of indicators, with the different exponential moving averages, the linear regression lines, the Bollinger Bands, all that. You'll get all that too. You'll get a link so that you can get that from freestockcharts.com. And remember, the operative word on Free Stock Charts is free. Again, thank you so much for joining us at Charting Wealth. We appreciate you. Go to chartingwealth.com, sign up for our newsletter. Let us hear back from you. Feel free to email us. Tell us what you think. If you have any suggestions, you need any help, we're here. God bless. From chartingwealth.com.